Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Sales International Limited. And here is your weekly technical analysis of LME 3-month nickel, zinc and tin. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of these patterns, levels, analysis or any related items on these, my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that,
LME 3-month nickel. The break higher during Christmas week up over the gold long moving average, which is currently at 15,475, as well as over the key levels at 15,665 and 15,840, saw a significant release of bullish energy that had been pent up for about 2 years. The run up to this move higher was formed from the double bottom built over November and December 2025 and the monthly key reversal up seen in December last year. These two ignited the rise we saw the move higher, extended into January this year. So what has this move up left us with? Well, we have 4 features to watch for. The first was the possible double top that now might be a possible triple top formed over January. This pattern depends on one key factor, and it's whether or not prices can drop down to the low zone of 16,835 seen 3 weeks ago, and then after that whether the market can press even lower or not. At the moment this seems unlikely, but it's still one to watch. The second is to consider if prices try and get down to that 16,835 zone and fail. We might then have to regard the whole December 2025 to date action or any part therein as a possible bullish halfway hesitation. This is another thing to watch for. Thirdly, we had a crossover seen 3 weeks ago of the rising green short medium moving average, currently 15,965, the mauve medium moving average, currently 15,645, and the gold long moving average, currently 15,475. This is a bow tie formation, and the moving averages have gone in and exited in the right order for bullish tinge about them. Consequently, we need to look to the future, and that means between 15 to 20 sessions after crossover, we can look to see one or more of the following: a change in trend, a reinforcement of an existing trend, volatility. Thus, please pay special attention to this market between the 29th of January and the 5th of February, as that is the window. The final feature is whether to regard the whole January action as a possible ascending wedge pattern, currently 17,805 to 19,180. Now I've not highlighted a pattern for now, but it can still be seen on my daily chart as we are still deep within this pattern. I cannot give an idea of directional targets either above or below, but I can give an idea of the potentials involved. Thus, for a confirmed break higher, we would have a primary potential of plus $1,230 from the break, and a secondary harder to reach potential of plus $1,950. For a confirmed break lower, we would have a primary potential of minus $625 from the break, and a secondary harder to reach potential of minus $1,950. Now please be wary, as any break higher or lower may first be a false break before a true break occurs. LME 3-month zinc. There had been here, and still are, a number of patterns affecting the market in recent times, all happening at the same time. The first is the dark blue mid-July to early October 2025 bull channel, which is currently 30.98 to 33.10. This captured most of the action, but was breached a few times, most recently this week. And whilst this breach has not been confirmed as yet, it is this time quite substantial. It's this time quite substantial a breach. The second pattern is the bright red May 23 to April 25 bullish Andrews pitchfork, especially the middle time, which is currently at 33.24. This halted the rise 2 weeks ago, along with the dark blue upper bull channel line, but was breached yesterday, and I've yet to see it confirmed. This breach higher is also being capped for now by two 50% Fibonacci lines of the March 20 to March 22 move at 33.29 and a 50% Fibonacci line of the April 22 to May 23 move at 33.77. A third pattern has emerged that became evident this week, and that is the bright green mid-December last year steeper bull channel, currently 31.88 to 33.94, which incidentally looks quite good. The question is whether we will see a halt to the rises or will see prices higher. With that in mind, I do note that the dark blue upper trend line crosses over the bright red middle trend line around the 9th of February. So a not unfamiliar date if you have been listening to my other metals commentaries. Please be aware of this as we move forward. LME 3-month tin. We had a gapping move higher in mid-January that started the whole huge move higher. The rise was fairly swift until the market breached the previous all-time high seen back in 2022 at 51,000. The day after this happened, the market started to fade. However, early last week, that changed with a combined bullish Harami and bullish closing white Maribozo, and we've seen prices rise to test a key overhead resistance. You see, overhead we have the bright red upper time, currently at 58.115, 58.115, and that's of the big old pattern dominating these large moves higher, the 2020 to 2022 bullish shift pitchfork. This was tested today, but so far held down the market. Last week I said the following about the future movements here, and I quote, "I think there are two courses for this market to go. The first is to try and replicate what we have seen in other metals markets, move up and try and form a possible double top. In this regard, I think this market is a little late when compared to the other metals, and I think even possibly too late for such a pattern. But we shall see. The second is to fall back and fill in the gap left in early January below between 45.780 to 46.255, and then decide what it wishes to do. Well, there is a third way, and the market has seemingly chosen to strike for that, and that is to look at the whole mid-January to date action, indeed the whole late December last year to date action, as a possible very large bullish halfway hesitation. Right now, that seems to be what the appetite of the market indicates. Thus, for a small January-based bullish halfway hesitation, well, prices have already reached their target, which is up in the 57.750 area. However, for a larger late December last year to date pattern, the target would be up in the 60.750s area, well over the bright red upper time. This potential move up might just end up being a breach higher, but in truth we would need to entertain the idea that it could possibly be a break higher, with all the implications such higher prices might bring. I said as much last week when I said, and I quote, "There is a third option, but that seems to be a little far-fetched right now, though I think I ought to mention it. This is to regard the whole 2026 action as part of a possible bullish halfway hesitation, in which case the bright red upper time will be tackled and broken. But as I've already said, that is a little far-fetched right now." End of quote. Well, it's not so far-fetched right now.
Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.